are going to be talking about something that should matter to all of you all. And that is why bonds should matter to your portfolios in this particular market environment. So, while I guess I do a little bit of homework, Leon's going to tell you why we chose this topic.
Yeah, so bonds are interesting, right? So Brent and I, we're not even okay. In the
Normally,
previous, yeah,
normally,
normal in the pre the Fed raising interest rates, which is the last 15 years, rates effectively went to zero during 0809 during the housing crash. So we've never been a fan of bonds because bonds weren't paying anything, right? I mean, you were getting less than 1% return on a short term bond of maybe 2 years up to like a 30-year bond. You were getting less than 1%. So we've never been a fan of bonds, right? But since the Federal Reserve has been raising rates the last year and a half, bonds
aggressively, aggressively.
aggressive, super aggressively. Bonds are now uh, serious competition for the stock market. I mean, you can get a bond right now as low. You can get a return as low as 3.5% up to right around 5.5%, just depending on the bond, the duration, which one you get. But you can get some serious return on your money from bonds right now at essentially no risk, and that's the main thing. We all know the stock market is a risky thing. It's one of the greatest wealth generators ever, but high risk. Bonds. I mean, like Brent and I, we've always said, we've ever since we've been in the market, we always typically get anywhere from, a bad year for us will be 15%. A good year for us will be north of 40, 50%, just depending on the year. I mean, again, I'm not saying we're that great, but just the stocks we pick generally.
We've been doing it for a long time.
Yeah, we've been doing it for a long time, and we take a certain amount of risk, right? We're not afraid to be in tech stocks, and but we know when to kind of dial it back. So, but right now, bonds, being that the market is basically stagnant, it's been in a range for the past year and a half. I mean, it was down. Now it's been in a range for the past year and a half. Bonds are a great investment. Again, 3.5% to five, maybe 5.5%, essentially guaranteed, backed by the full faith of the federal government. You get your principal back plus your interest. It's a solid investment right now. Now, when we move past all this Fed raising rate stuff and the craziness of the war and everything, when we go back to like 2019, no, bonds will still probably pay in the 3% range, but they won't touch the stock market where we're getting 10, 30, 40, 50% per year in the market. So,
And
um,
today, I know some of you all are going to be like, well, what about tips? What about strips and floating rate?
I bonds and
Yeah, I
yeah,
bonds, H, double H. We're not talking about all those today, and we're not talking about savings bonds either. In this particular podcast, we're talking about Treasury bills, Treasury bonds, and Treasury notes. So we're staying in that space of those three. If you have questions about strips, tips, floating rates, savings bonds, and Series E, double E, I, H, and double H are not the same. Some of you all think they are the same. They're not the same, and there are restrictions for all of them. All of them have their limits. All of them have different thresholds on how much you can invest. Again, for today, if you have questions about T bills, T bonds, or Treasury notes, that's what we're talking about. Now, most of this information can be found through Treasury Direct, so let's start there. But I'm going to give some information. I made some notes on how to identify the difference between a T bill, a T bond, and notes. And then Leon's going to give you all some of the numbers we've seen as it relates to these. And this, you want to hear this part. Like, you definitely want to hear this part. So, Treasury bills, normally they have a maturity anywhere from 1 month to 52 weeks. Before I go on, I know some of you are going to be like, hey, you can get maturities that are different, lesser, or more if you're buying at auction. Again, we're keeping this very simple. I know some of you who are more familiar with these things, you know how to break some of the maturity framework by buying it secondary market at auction. We're not talking about secondary purchases. We're talking about if you were buying it through Treasury from the government. So with the T bill, you're talking a 1 month to 52-week maturity date. There's and the way T bills normally work is they're sold at a discount. So when you sell at a discount, whatever the face amount of the T bill is, that at the maturity, that's what you're receiving. But the difference between what you purchase at, the discounted rate, and the face amount normally works out to be a percentage. So it's still a percentage, but it's based off of the discounted rate that you're purchasing at. So please note that. let's see, you can buy it anywhere from $100,000 increments. $100 increments to $10 million increments. And once the maturity is done and that cycle is complete, you can reinvest the money. However, when you do reinvest it, it's not at the same interest rate or discount rate of the original one you purchased. It will be a new discounted rate, which equals to a percentage at that time in that space in the economy. So for bond,
and also then when Brent says discount rate, also think interest rate, the rate you're getting, the return you're getting from that bond, generally.
And for bonds are normally 20 to 30 year maturities. So again, for those of you all who are like, hey, in the secondary, I'm not talking about the secondary market. If you're purchasing a bond in the secondary market, yes, the maturity might be a little shorter. But in general, coming from Treasury Direct, you're talking 20 to 30 year bonds. They also have that ability to purchase them anywhere from $100 increments all the way up to 10 million. Now, the difference here is you're actually looking at a stated interest rate when you make the initial purchase. And that stated interest rate is paid out in 6-month increments. So every 6 months, you do not receive the principal back. You receive a portion of the interest that is equivalent to 6 months of interest accruing on the face amount. And what that means is this. If you put $100,000 in, please in 6 months do not assume that you're getting your interest plus $100,000 back. The only thing you're going to receive is the interest for that 6-month period on the $100,000 amount. At the maturity of the bond, you will then receive the $100,000 back. Again, please do not think that, oh, I was supposed to be earning interest every 6 months in addition to getting this big lump sum with my principal back. No, they're paying you out the interest over those 6-month period for the number of years you hold that particular bond. And then you get your initial principal amount back, the exact amount back. Treasury notes. Treasury notes are a little different. They can be in 2, 3, 5, 7, or 10-year increments. Please don't go back to this secondary market. We're not talking about that. And I keep reiterating it because it's very easy for people to confuse a treasury note that they may have seen with the 1-year maturity because it was on the secondary market at auction to an actual issuance of a new treasury note coming from the government. So coming from the government, new out the box, it is normally in increments of 2, 3, 5, 7, and 10 years. Now, those as well have fixed interest rates. Those fixed interest rates, which Leon will be going into in just a second, are paid out also in 6-month increments. So if you hold it for 2 years and it's paid out for every 6 months, you're going to get 4 interest payments. 4 interest payments, and then you get back your original amount. Not more, not less, your exact amount that you gave them. You will receive that back at the maturity of that note. This treasury note also can be purchased in increments of 10 to 10 million. I keep saying 10. $100 increments up to 10 million. Once it matures, you can reinvest that money, but you're not reinvesting it into the same agreement of the note that you had before. It's an investment into a new treasury note at the new stated rate, whatever's being given by the Fed at that particular time. That's what you'll be purchasing at. So don't think, oh, I'm just going to renew this and have the exact same numbers I had before. That's not the way it works. Once it matures, that is done, and you are purchasing a new agreement because each bond is an agreement between you and the government for, basically, you're a debtor. They become a debtor to you. So now they are in debt to you to pay you back this amount of money.
Yep. So I'm gonna cover some of the actual rates, and the reason we're talking about this is because rates on bonds are pretty competitive right now. The stock market right now is up. I mean, after today, last week, I think it's up like 6-7% for the year. And so the first one I'll go over. So Brent and I looked this up a little earlier. The 4-month Treasury bill right now is paying the most recent auction is paying 5.19%. Now, like I just said, the stock market right now through today, I think roughly is up about between 5 and let's say 7%. Now that's with risk, right? We all know the stock market is risky. Some of y'all may market, you may be down for the year, you may be up, whatever. If you were to theoretically buy a 4-month treasury bill right now, let's say right now, let's say the stated return is 5.19%. In 4 months, like Brent said, you're going to get back your principal plus your interest in 4 months. That's a 5%, over a 5% return in 4 months with essentially no risk. And the reason I'm saying it, essentially no risk, is because the interest on these notes, bills, and bonds are paid by the federal government. Federal government generally isn't going anywhere. They can print money out of thin air, like it's not a big issue. So never want to say anything's guaranteed, but this is about as close as guarantee you can get. And there's really no there's I mean there's really little risk in buying bonds. But again, 4 months you can net 5.19% if that's the stated rate at that time. The most recent auction we saw was 5.19%, or the most stated a number we saw on Treasury Direct was 5.19% for a 4-year Treasury bill. That's
Leon, real quick, for those of you all who are maybe walking or listening to us this podcast, the time of this is May 2023. So, these bonds, these notes, these bills, they all change, some daily, depending on when you look at the window or when you go to Treasury Direct to find the rates, or if you are getting in secondary market. So please don't think that if you're hearing us and it's August and you go and look, the rate may be different, because, talking 2 months ago, the rate was about 1% or, between 0.5% and 1% lower than what it is this month. Mm-hmm. So these are moving percentages, and there's a living organism behind the pricing mechanisms for these bonds. It is not fixed forever. And please don't run to Treasury Direct and say, these guys misinformed me. If you're listening to this later, the percentage interest or the discount rates may be different.
Yeah, the rates we're quoting are just a snapshot in time. So like Brent said, if you listen to this now or tomorrow in 6 months, it won't be the same, because it changes every time. So that was a Treasury bill. Like I said, the most recent 4-month quote that Brent and I saw was 5.19% for a 4-year Treasury bill. Getting 5% in 4 months is awesome. Getting over 5% in 4 months also. Now the Treasury bond, which is anywhere from 20 to 30 year, between 20 and 30 years, was paying, again, our most recent quote we saw was 3.97%. So we're saying roughly almost 4% for a bond anywhere from 10 to 30 years. Now, you look at that long term, you're like, well, that's not really that much. That's only 4%. True. But if you're sitting on $100 million, that you do not want to have any risk in the stock market, because a 2-3% move on $100 million is a lot of money.
Well, real quick, Leon, let's say 10 million, because stipulation is up to 10 million per household.
Right.
So it's not 10 million per person. Leon actually pointed this out earlier, so I'm reminding you of what you told me. Right. It's 10 million per household. So let's not say 100 million.
Yeah. So if you go and buy 10 million, if you have 10 million to invest, you can buy a Treasury bond. And you just want to stack that money away for years, not even really think about it. A 10-year bond, anywhere from a 10, 30-year bond is good. Again, you may think low interest rate, but you got to look at the amount of money you're investing. For us, I wouldn't really even consider a bond paying 4% over 10 years. I would definitely be in the stock market. But a Treasury bill paying, in 4 months, 5%, I would definitely look at that. And then finally, Treasury notes. This is kind of the mid between the Treasury bill, Treasury bond, as far as duration. These go anywhere from 2 to 10 years. And last quote we saw, a 5-year right in the middle, was paying 3.79%. So again, you're looking at 5 years, you may think, oh, that's a low percentage. You also got to look at the amount of money you're working with. So we're just putting this out there for because people watch these and hear these, have different suitabilities, different amount of money they can invest. So some of these may work, may not. Some of these may work for some, may not work for others. But I think for everybody, I don't know how much money you have, a 4-month Treasury bill paying over 5% is awesome. And that's something we should all look at, especially in this topsy-turvy market that we have, that we're in right now.
Yep. So with that being said, for today, we owe you 2 stock picks. You can definitely go into IAMembers.com, check our platform, find our stock picks. But if you're not a member, it's a great time to become a member. And for those of you all who have had questions about what we talked about today, we'll do our best to answer them as quickly as we can. But you can go to Treasury Direct and get a lot of, and that's treasurydirect.gov. Treasurydirect.gov. One thing Leon and I were talking about, and I know I'm jumping around a little bit, but this is good information. They have a 1-800 number that you can call. So if you have questions, you can call the 1-800 number, and they're very knowledgeable. Now, depending on what time you call, they're open between 8 a.m. and 5 p.m. Monday through Friday. You can get in contact with them. It's probably going to take about an hour to get through. Maybe 15, 20, 30 minutes, the best. But it's worth the phone call. If you have time to put the phone down, leave it on hold, and just ask them some questions about, number one, how do you make a purchase? Because you also have to have an account set up. How do you set up an account? Ask the questions from their 1-800 number, get your answers, and let this just be the catalyst to lead you over there to say, you know what, I need to know more information, and who better to ask than Treasury Direct? So,
Yep.
Again, if you're interested in joining IEA, you can go to www.ieamembers.com. We would love to have you in our community. If you're trying to figure out, I need some help personally, and you want to contact Leon or I directly, you can definitely put something in the comments or contact us via the contact@IEA Now email address, and we'll be happy to do our best to get in touch with you and see what we can do to help. Leon, you have anything before we go?
Yeah, just consider bonds. I mean, this is the time to consider them. You can lock in some really good percentages. I mean, I stress that 4 month, and when I say 4 month, if you actually go to Treasury Direct, it may say, it usually quotes it by weeks. So you may say you may see 17 weeks. That's the one I'm quoting here. It's like 4.25 months, but just 17-week bond. Most recent quote we saw was paying over 5%. So, hey, if you can get that much in 5 months with no risk, I think everyone should look at it.
Yeah, and also too, just to point it out, when we say bonds, we're really meaning treasuries.
Sorry, and yes, true. What I was quoting is a Treasury bill.
Yeah,
I'm quoting the Treasury bill, the 4-month Treasury bill, because the Treasury bills, the Treasury bonds, and the Treasury notes. We just kind of went all over 3.
Yeah, but
what I'm quoting,
the overarching thing is look at treasuries.
Yes, look at treasuries in general. But the one I'm quoting specifically is a Treasury bill, 17-week Treasury bill. Most recent quote we saw was paying 5.19%, which is essentially 4 months return.
And as always, make sure it makes sense for your suitability. We aren't saying that everybody immediately go out and purchase it. If it doesn't make sense, it doesn't make sense. Speak to your financial professional, whoever they may be. But we do think it's a very viable option or addition to anybody's portfolio in this current market environment. So we thank you all for watching, and we look forward to being back on in 2 weeks.
2 weeks.
See you all later.